If you are looking to fix your mortgage, you might want to do it soon as rates are going up. Despite the Bank of England cutting its base rate to 4% last month, which was followed by a number of rate cuts from other lenders, it seems that these cuts were short-lived. This week, HSBC became the latest high street bank to increase its fixed mortgage rates by up to 0.20 percentage points. Last week, Nationwide increased its rates by up to 0.20 percentage points, while Barclays increased rates by up to 0.10 percentage points. Hina Boudia, partner at brokers Knight Frank Finance, said, "We saw a handful of lenders notch up rates last month, but that's gathered momentum in the past week. Many of the larger high street lenders have raised rates, and when they move, others often follow. So far, these moves have been by a few tenths of percentage points, but that still amounts to a meaningful uplift in monthly outgoings for borrowers." So, what does this mean for you? Well, if your mortgage is coming to an end soon and you're on a variable rate, you could see your payments increase when your new deal starts. But if you've got a fixed-term mortgage that's not due to expire for a couple of years yet, then it probably won't affect you immediately. However, it could be worth thinking about fixing now if you don't want to be exposed to the risk of further interest rate rises. Boudia explains, "There is still a lot of uncertainty around where interest rates will land and how long they will stay there. As such, locking in a fixed rate now could provide certainty over your monthly costs and peace of mind that your mortgage payments won't increase for whatever period you choose to fix for. But before you do, it's worth shopping around to see if you can get a better deal elsewhere because, according to data from Financial Information Service, Moneyfacts, the average 2-, 5-, and 10-year fixed-rate mortgages on the market have all increased in the last month. The average 2-year fixed has risen from 4.73% in November to 4.89%. The average 5-year fixed has increased from 4.88% to 4.98%, and the average 10-year fixed has gone up from 4.93% to 5.06%. So if you are thinking of fixing now, you may want to consider a shorter term. Boudia says, "A 2-year fixed-rate mortgage might make sense for those who are happy to revisit the mortgage in a couple of years' time and potentially take advantage of hopefully lower rates then. However, if you want certainty for longer, a 5-year fixed rate might be more suitable, especially if you're not planning on moving home in that time frame. If you'd rather not fix, then you could always go for a variable rate mortgage, although you'll need to be comfortable with the risk of interest rates going up. But even then, you might want to consider getting a tracker mortgage, which usually offer lower rates than standard variable mortgages. If you've seen my other videos, you'll know that just last month the Bank of England cut its base rate from 5% to 4.5%, the first cut in a string of reductions that many expected would bring mortgage prices tumbling down. But, contrary to these expectations, several major lenders have been increasing their rates since last month, and experts say there are a few reasons for this. For example, bond yields have been rising recently, and this can push up swap rates, which in turn impact fixed mortgage deals. Swap rates are interest rates that lenders exchange with each other as a way of managing risk. They reflect the market's view of which direction interest rates will go, so lenders use them to set their own rates. As a result, higher swap rates can push up mortgage rates. Meanwhile, inflation has also continued to increase since last month's base rate cut, rising to 3.8% in July. The bank uses its base rate to help control inflation. If inflation is above the bank's 2% target, it may increase its base rate to encourage people to save rather than spend, and vice versa if inflation is low. Wage growth has also been high, which could increase spending, driving up inflation further. The bank will also be looking at this when deciding whether to cut rates again. Karen Noy, mortgage expert at wealth manager Quilter, said, "Although the bank recently lowered its base rate, we are seeing lenders raise mortgage rates again. This may seem contradictory, but it reflects the complex forces currently shaping the market. Inflation also came in higher than expected in July, which has unsettled expectations around future rate cuts. As a result, swap rates have increased and made borrowing more expensive for banks and building societies. David Hollingworth, Associate Director at L&C Mortgages, added, "Although the base rate was cut, there have been more question marks raised about how much further rates will fall and, perhaps more importantly, how quickly. More cautious tones around the pace of rate cuts means that the cost of funds for lenders when pricing fixed deals has edged up. Consequently, the increase in market rates is feeding through to mortgage deals. So when will mortgage rates fall? Well, according to the latest predictions from the markets, they expect the Bank of England to reduce its base rate by 0.5 percentage points in November, with further cuts of the same amount in February and May next year. However, as we saw last month, the bank doesn't necessarily follow what the markets are predicting and has been known to spring a surprise or two. Although there are still a handful of rates available for sub 4%, the average 2-year fixed rate is currently 4.98% according to Moneyfacts, whilst it sits slightly up at 5.02% for 5-year deals. This compares to a week ago when the average 2-year fixed was 4.91% and the average 5-year fixed was 4.96%. Moneyfacts finance expert Richard Carter said, "There is still a good selection of mortgages available at sub 4%. Although this is slowly reducing. However, if you do want to secure one of these, you may need to move quickly as lenders are continually reviewing rates in this current climate, and there is no knowing how long they will stay at their current level." The average rates on both 2- and 5-year fixed mortgages have ticked up over the past week, and this is likely to continue if swap rates remain at current levels or increase further. So, if you're hoping to secure a mortgage at a lower rate, it's important to keep an eye on the market and be ready to act quickly when you see a good deal. You can do this by using a price tracker or by speaking to a mortgage broker. They'll be able to tell you which lenders are offering the most competitive rates at the moment and help you to secure a great deal. Remember, though, a good mortgage rate is only part of the equation. You also need to consider the lender's fees, the property type, and your own personal circumstances. So take your time and shop around before making a decision. Thanks for watching. If you found this video helpful, please do leave a like and subscribe for more. And if you'd like further recommendations on the best mortgage deals available right now, then you can get in touch directly through the provided details. Inflation almost double the bank's target and swap rates still high. Mortgage experts anticipate rates could keep creeping up in the near future, but they stress that things could change if inflation dramatically decreases or other economic circumstances change in the next few weeks. Ms. Noy said, "Looking ahead to the rest of September, we expect continued volatility. The next Bank of England decision is due on the 18th of September, and while another cut is possible, it is far from certain. Much will depend on how inflation behaves over the coming weeks." For home buyers and those looking to remortgage, this means a period of uncertainty. Rates remain relatively high compared to the historic lows of recent years, and affordability continues to be a challenge, particularly for first-time buyers. Nick Mendez of brokers John Charcot added, "Markets had already only priced in one more rate cut this year, and with swaps now broadly steady, we're unlikely to see any major downward shifts in fixed pricing. What's more likely is some small reductions here and there, followed by repricing upwards again as lenders manage pipeline and service capacity. Hopefully, this means a period of relative stability rather than another sustained round of increases." Moneyfacts. Commodore UK finance expert Richard Carter said, "I think we'll see rates continue to be volatile. It's very difficult to predict where they'll go. Typically, we see mortgage rates follow the base rate. However, we've seen the base rate cut 3 times this year, and mortgage rates have only reduced once. This shows that there are other factors at play and makes me think that we're going to see rates go up and down in the short term, perhaps in response to what's happening with the base rate. It's not good news for those trying to buy a house because it means that the uncertainty continues and people are going to struggle with affordability. And when you're selling a house, You might find that you can't sell unless you're in a position to offer a low-rate mortgage because buyers are going to be struggling to get a mortgage. Mr. Carter said that if inflation does drop significantly, or there are other changes in the economic outlook, then we could see a more dramatic shift in the mortgage rates. Nationwide's chief economist Robert Gardner said he expects the bank rate to remain at 5.25% until the end of the year, but acknowledged that there is a risk of further increases if inflation does not decline as expected. He said, if inflation does come down as expected over the coming months, there's a possibility that we'll start to see the base rate come down as well. However, it's too early to say whether this will feed through into mortgage rates. Lenders will also take into account their own funding costs, which have been increasing recently. So overall, the message from the experts is that we're likely to see some small changes in mortgage rates over the next few weeks, but nothing major. However, they also stressed that things could change if inflation falls sharply or other economic indicators worsen. So if you're thinking about taking out a mortgage, it's worth keeping an eye on the markets and being prepared to act quickly if the rates fall. If you're due to remortgage in the next 6 months, or are due to complete on a house purchase in the next 6 months, you need to act now. That's the message from experts who say now is the time to lock into a deal, and I'll explain why. But if you're new here, I help you make informed decisions about money. So let's jump straight into it. There are 2 reasons why you need to think about securing a mortgage now. First, if you're on a fixed rate that's due to expire in the next 6 months, you need to start thinking about what you're going to do. You may have received a renewal pack from your existing lender with a rate that looks pretty eye-watering. Don't just ignore it. You don't have to accept that rate. Now, if you're on a variable rate, then it doesn't really matter when you start this process. But if you're on a fixed rate, then you need to start looking at your options now. Typically, you can swap onto a cheaper deal, even if your mortgage term has started. However, you can't get back a cheaper deal once it's gone. Ms. Noy, a mortgage expert at a financial firm, said, anyone approaching the end of a fixed deal should consider securing a new rate early to avoid moving on to a more expensive standard variable rate. Many lenders allow borrowers to lock in a deal now and switch later if better options become available before completion, which can offer some flexibility in a shifting market. The second reason is because if you're buying a property and you have an offer accepted, you want to get a mortgage in principle before you start the process. Again, according to research by the financial firm, those that have a mortgage in principle are twice as likely to complete on a property. And if you have a mortgage already lined up, you're in a stronger position to negotiate with a seller. So if you're looking to move home in the next 6 months, then now is the time to get a mortgage in principle and lock in a great rate. The mortgage market is constantly changing, and there are a lot of factors that could influence interest rates over the next few months. According to a recent report by the Bank of England, they expect the base rate to continue to rise throughout 2023, peaking at 4.5% by May. But there are also other factors such as inflation and the economy that could cause rates to go up or down. So if you're looking to remortgage or buy a new property, then you need to think about securing a rate now so that you're not caught out by rising rates. Mr. Hollingworth, a mortgage expert at a financial firm, added, as market sentiment plays such a big part. The rest of the year could see more further ups and downs, but currently securing a rate and then reviewing it before completion is the right approach. So if you're due to remortgage in the next 6 months, or are due to complete on a house purchase in the next 6 months, then now is the time to act, and if you found this helpful, please do share for more money tips. Thanks for watching. If you're looking to buy a new home, or you want to switch to a better mortgage deal, you need to know how to get the cheapest mortgage rate. First things first, don't assume the rate you're currently paying is the best available. Get in touch with a financial advisor, or use a mortgage or remortgage calculator or comparison site to compare a range of deals and find the best one for you. You could even speak to a broker. They often have access to deals you can't find online, and they'll usually let you know if rates are about to change. Next, you could access cheaper rates if you have a lower loan to value, also known as LTV. This is the amount you borrow versus the amount you put down as a deposit or own in cash. For example, if you're buying a £200,000 home with a £40,000 deposit, you'd have an LTV of 80%. If you've been with your current lender for a while and you're remortgaging, your LTV can change depending on the lender's current view of your home's value. If they think the value has gone up, this will lower your LTV, while a down valuation can mean your LTV goes up. For example, if you bought your home 5 years ago and the market's gone down, the lender may value your home less than you paid for it, which will increase your LTV. If you're close to 60% LTV, you could ask your lender to reduce their rate if you overpay some of your mortgage before switching. Overpaying will bring down your house value, which in turn lowers your LTV. So if you're able to overpay a large chunk of your mortgage and bring it below 60% LTV, you could typically access cheaper deals. However, make sure you check with your current lender, as some don't allow overpayments. If you're applying for a mortgage on your first home, putting down a larger deposit to lower your LTV could open up cheaper mortgage rates. Emma Graham, director at Hodge Bank, said, "Your deposit size can dramatically affect the rate you're offered and the total amount you repay over time. Before you apply for any mortgage, make sure your credit score is in good shape. Lenders view people with a good credit history as lower risk, which can lead to cheaper offers. You can get your credit report from one of the main credit reference agencies. So, there you go. That's how you can get the cheapest mortgage rate. To learn more about mortgages, visit our website.